Hello, everyone, and welcome to the Cash Flow Connections Real Estate Podcast. I'm your host, Tyler Lyons, and I'm very excited for the guest that we have here today. He's the CEO of ASYM Capital, and he has over 20 years of experience in various aspects of real estate. He has led acquisition and disposition teams on over $550 million in multifamily transactions. He's also a former corporate banker where he's involved in over $1 billion of financing and real estate transactions. Sam Morris, welcome to the show.
Hey, Tyler, man, thanks for having me on, bud. It's great to catch up with you again and great to hear how things are going, especially with you and your family. So that's awesome. So
Appreciate that, Sam. Yeah, definitely great to have you on the show here today. Super duper excited to have you and to dive in with you. And I know, I touched on this briefly in the preamble here, but you've got an extensive background in the world of real estate. And before real estate, you were a corporate banker. You did a lot of lending, so you got a well-founded knowledge in the space. But to kind of get things started off here, what did it look like for you when you first started getting investing in the real estate space? Do you have any specific aha moments that drew you into it? What ultimately motivated you to get into the real estate space more on the investing side?
yeah, it's so funny you say that. I tell a lot of people because I actually started as an investor myself. So I
Wow.
started investing on the commercial side, the bigger projects, things like that, back in 2007. And it was actually being a banker, which was something that really opened my eyes to it because I was really great at underwriting.
Yeah.
When you start in banking, cutting your teeth as an analyst, all you do is underwriting all day, every day. And it felt like for years. And so I always joke because people say, it takes 10,000 hours to master a skill. And so, if that's the case, I mean, I was a master underwriter probably by the time I was 25, right? I'd put my hours in doing a lot of underwriting. But what it did was it gave me a great insight and a great understanding of how these transactions worked. And being a lender on them, I was actually able to see how people operated, what worked, what didn't work, what was good, what wasn't so good. What do you do in these scenarios? Or how was this reaction good or bad? And so it really opened my eyes into, man, there are certain people that do really well in this. And if I can actually be on the equity side where I'm part of the ownership, I can make a lot of money the way some of these other guys are. And so I started my journey in 2007 as a passive, literally just investing into just one deal at a time kind of thing. And it was great because it gave me just an immense amount of knowledge of seeing it from the other side, right? On that equity side, the ownership side versus the lending side. And so really that's how I got my start and cut my teeth on things.
That's awesome. And I'm going to ask you to go back into the time banks a little bit here, but when you kind of were a corporate lender and you were the underwriter and you got to see firsthand, like, okay, here's some things that seem to be working pretty well. Here are some groups that are doing really well versus here are some places where people are falling down or where maybe things aren't working so well. Can you recall any of kind of your early lessons that you may have gathered, back in your lending days, underwriting all those deals, seeing deals that performed and ones didn't? Like, what were some of those early lessons that you took from some of those situations?
Yeah, so a lot of it was those who were actually actively involved in it just tended to do a lot better, meaning I had some kind of active role consistently with the property, whether it was on the asset management side or the property management side, but those who were effectively willing to get their hands dirty, they typically did a lot better than those that stayed truly passive from it. And those that had actually had some battle scars, right? In '07, we hadn't even gone through the '08, '09 crisis yet, but there were guys that had gone through the '80s and things like that, and they had battle scars.
Yeah.
And it was really interesting watching how some of them would handle certain things like an insurance claim,
Yeah.
right? They know exactly who to go to, what to do, how to do it, and what they were going to do to get the best result possible from their knowledge. And so knowing and watching some of these things ahead of time, it really led me into thinking, all right, here are all these things and all these traps that happen with new people, right? That I would want to avoid if I was going to be putting my own money into the deal.
Yeah, that's super duper helpful. And, when I look at your background as a corporate lender and you talked about kind of getting that 10,000 hours in probably multiple times over just in the world of underwriting. So I assume then when you got into the world of real estate, you started investing passively. You had a very solid handle on the financial aspects of it, right? The underwriting, the numbers. You can pick up a pro forma and kind of glance through that thing and really get a feel for the deal pretty quickly. But when you look at some areas where maybe the learning curve was a little bit steeper for you, when you're kind of getting into the world of commercial real estate and starting to participate as an investor, what were some areas where you'd say your learning curve was a little bit steeper given your background and that you had kind of that the solid fundamentals already in the world of underwriting.
Yeah, it's actually what you would think. It was more the qualitative side, right? So it was more, we would go, all right, well, hey, if I'm going to lend money on this, it's the project base, it's the sponsor base. We're looking at those two things really majorly, right? The deal itself and the person running it, right? When you're becoming an investor, you actually have to pull back just even a little bit more and go, give me the macro, right? Tell me what's going on with all these other things of that nature. Give me the competitors, give me the migration patterns, give me what's going on. It's a whole lot more that goes into it on the qualitative side than just straight up the numbers. And so it was something that I go, oh, wow, there's a lot more to learn here. And it was fascinating to me, right? Because you can sit there and go, man, there's even more that you can build, data and KPIs from to be able to come up with what's going to be really good from a long-term perspective of an investment.
Yeah, absolutely. Absolutely. And I know that so as you kind of got into the world of real estate, so I mentioned in the intro here that you're responsible for acquiring and managing a pretty large portfolio of multifamily real estates. You acquired $550 million worth of transactions and ultimately oversaw the disposition of all those as well. So given your experience with that, I'd love to hear some of your best practices in terms of managing, a large multifamily portfolio effectively. From that experience, do you have any sort of words of wisdom, key insights, so on and so forth, in terms of how to manage effectively a large portfolio like that?
Yeah. And what I would tell you is it's know what you do well, and then make sure you surround yourself with team members who do other things really well,
Mm,
right? Not what you're great at. So if you're, let's just say you're the asset manager of the property or the portfolio, right? And you're really good at the sales aspect of it, or you're really good at communicating to the investors what needs, what's going on. You're going to want to make sure you have somebody else who's crunching the numbers nonstop and providing those KPIs so that you can actually provide the information in the appropriate way. And so really what it is you're not going to be able to do it yourself, right? You surround yourself with those that are smarter than you, which wasn't hard for me, right? You can find a lot of great people that are out there and have them plug in where you're lacking so that you have a full and complete business model that you can move forward with.
makes sense. And when you were kind of involved in that process, like where did you lean in the most? Did you lean in the most on like the acquisition side? Then you kind of surrounded yourself with people who are like asset managers and did some of the other aspects of it. Like where did you really lean in and where do you try
Yeah,
to surround
ironically,
yourself with other
yeah,
people?
ironically, I'm really good on the underwriting side and that aspect of it, but to me, I'm better on the negotiating and acquisition side. Um, as a banker, I was really more of a salesperson too, anyway, and so
Mm,
it actually being able to convey what was needed, whether it be to a broker, or to a seller, or to vendors, or things of that nature, that actually came very naturally to me. Um, and then hiring out people that can help you with the high IQ level type things of the underwriting and getting into the data and the analytics of things really was something I was willing more to push off, more of the administrative tasks and things like that, so that we could be working more big picture. And I think I've always done well being more big picture of things versus getting into the true nitty gritty and the micro of things, and finding those that can help bring that up. Obviously, it's very important. You have to put attention to it. But for me, it was definitely more on that acquisition side, seeking deals and putting all the aspects together to close it, while putting the right people in place to be able to get that done.
yeah, that makes a ton of sense. And when you're managing a portfolio of that size, I'm sure there's a lot of key financial metrics that you're looking at. What were some of the most important metrics that you would kind of monitor day to day when you're managing that portfolio? Is it more of the acquisition sort of metrics, more of the operating sort of metrics and KPIs? Like what were some of the most important metrics that you would look at and that you still look at to this day?
Yeah, I would say it's more on the operations side. I mean, you're looking more at, we're in an ever-changing world. So you're looking more at the basic things that you would actually think of, right? Occupancy, right? And more economic versus actual. And so you'll look at collections and things like that. So you're watching how they're actually performing. But in addition to that, it would be the leads and where those generational leads are coming for, what it's costing you for that, and how we're closing on those. So how effective is it? Right? Because those are going to be the basics of just kind of the top line numbers, right? And then you're digging in below that and going, all right, do we have water leaks? Do we have anything like that? And to where you can see in the numbers. So we often joke, especially with the operation team, that we go, we read numbers the way you read words. So to us, it tells our story, right? And so we know it from a quantitative perspective, but we rely on you to tell us from a qualitative perspective of what it is, right? And so it's pretty simple from the standpoint of you can tell when something's off if you're trending, if you got the tracking and you've been trending it, right? So you can tell when something's trending down or trending up, but you may not know the whys. And that's why having everybody come together and have that communication, however often that needs to occur for you to be able to get those answers, that's where it all comes together.
Makes sense. And when you're looking at those metrics, like you said, they kind of tell you a story. You're looking at those KPIs, what direction are they trending? You get the story and the why behind why some of those numbers are changing, and you get a story of how the property is performing. And when it comes to asset management and managing these portfolios, oftentimes it's a big exercise of project management and of holding people accountable and making
Sure.
sure that, okay, here's what's going on at the property, here's kind of our plan of action, and now I need to like hold people accountable to make sure that these changes happen and the property performs like it should. So when it comes to really, managing people and kind of holding them accountable to make sure that they're going to do what you need them to do you have any advice or strategies for people who are out there, asset managing properties, executing a business plan to really hold, third party property managers, community managers, et cetera, accountable and to make sure they're kind of getting out there and doing what you want to see done?
Yeah. So we always joke, for years I've talked about the difference between property management and asset management. And what we say is property management looks at the world through yellow glasses, right? And asset management looks at the world through blue glasses.
Hmm.
And together, because we talk about money so much, if you combine them, they look through the world through green glasses, which is what we want. And on the asset management side, you typically have what I would call very high IQ people, right? These are number crunchers. These are really intelligent, smart people, right? And it's not to say property management isn't high IQ people too. It's just they're typically higher in what we would call EQ, right?
Hmm.
And which makes sense. They're dealing with more people and
Yeah.
more emotional aspects of the business, right? And so, when it comes to certain things like melding that together and having the understanding, that communication barrier that you have with a high IQ and a high EQ person, it's typically what you're trying to marry together to be able to convey whatever it is for the best interest of the investors. What's interesting is what you'll find is it could be like for instance, right? One of the things that we asked, just a week or two ago was we were noticing an increase of work orders at a
Hmm.
particular property, right? And there was a trend of increasing amount of outstanding work orders, right? So naturally, asset management would go, hey, what's going on? Are we not getting, is there not enough time in the day? Is something happening? Are our, maintenance team, maintenance staff overworked? Are we not getting to where they're asking those pointed questions only to find out yeah, we're experiencing turnover now, right? Over
Hmm.
this from the management team going, oh, you didn't know this, right? Well, you had a maintenance person who was probably in charge of doing a lot of this who had, you know, 2 feet out the door already. And so they really weren't giving it their all. Well, it shows
Hmm.
up in the numbers,
Yeah.
right? And so that's a great example of, hey, here's something that the numbers are suggesting we have an issue. We're having to ask what's going on. And property management's like, oh, well, the actual answer to that is this. And you go, well, here's how this impacts the numbers. And this is how it actually impacts the bottom line, guys. And so the hesitation to, move on or to get another person in there has cost us this kind of time or these kinds of dollars, right? Which now you may not have move-ins that can happen as fast or things of that nature, but you might have residents who aren't as happy because you're not able to get to the request in a timely manner. All these things have impact on the actual numbers itself. And on the asset management side, they can calculate what that is. Property management side sees it a little bit differently, and so that's why we try to blend it all together. And it's just that communication between those two, but then letting them know, hey, we're looking at this stuff, right?
Yeah, it's really helpful. And that's a great example, too, of how some of these metrics tell you a story about the property, right? It starts off as, okay, I start to see more maintenance work orders, and maybe they're taking longer to get completed and they're starting to accumulate. Eventually, that starts to snowball in bad resident satisfaction. And then it starts to result in people kind of sneaking out the back door and maybe occupancy impacts, right? It's like really kind of understanding the story of how these different metrics interplay and what that might tell you about the property. It's all really important. So yeah, great insights there for sure.
Yeah. We had another one too, just that, kind of, this was years ago. And I mean, this will actually tell you, it's just really specific. It was leads were not being followed up on, right? And we
Mm,
saw it in the numbers. The asset manager brought it to my attention. I said, well, hey, bring it up with the regional and just figure out what's going on. The following week, same thing. Leads were not being followed up on. And then it was, okay, now I have to go ask the regional, hey, what's going on? At that point, the regional's like, I'll go figure it out. Right. So this is 2 weeks in. The third week, same thing. And
mm,
we went back and go, hey, we're spending a lot of money to generate leads. Right. And they're not being followed up on, only to find out that the property manager, she unfortunately was going through a divorce.
mm.
And so her mind was not in the right space to do a lot of this. And so it was, hey, you need to give her the support she needs to be able to do her job. Right. Um, but it was seen in the numbers.
Yeah.
It was actually seen in the numbers that we have an issue. Now, we didn't know that that's what was happening, right? But that's a life event, right? That's something that's normal life for certain people. And it can actually show up in the numbers before anybody really knows about it.
Yep.
And so, that's just a great example of how, we reading numbers can actually tell you that there's something going on. We just don't always know what it is. So,
Yeah. Yeah, it's another excellent example, and it really spells out the importance as well around keeping a very regular cadence on those KPIs, keeping a very regular cadence on those asset management meetings each week, and staying on top of it. Because yeah, sometimes these numbers might tell you a story, and sometimes it takes some digging into, and it might take some time to figure out what that story is, right? So if you're kind of just sitting back and cashing checks and just kind of checking the financials every month, and you're not really monitoring it day to day, week to week, and really staying on top of it, a problem can really mushroom much larger and much quicker if you're not like really kind of monitoring it week in and week out.
very
So,
much so.
yeah,
Yeah.
another great example there. And like we talked about, so you built a pretty large portfolio here, you scaled a pretty large portfolio. And anytime that you build a business or scale a business, there are always growing pains. There's always things that you learn, and you always reflect on it and say, hey, gosh, I mean, if I would have known this while I was building this portfolio, that's a mistake I probably wouldn't make again. So when you look at your experience and kind of scaling a large commercial real estate portfolio, what kind of advice or recommendations might you have for emerging sponsors out there who are kind of out there buying their first few properties, looking to scale a larger portfolio? What kind of words of advice or wisdom might you have, or maybe mistakes that you had that you can save them from making themselves?
Yeah. So two things really come to mind. Um, and one may be kind of counterintuitive, but I would have gone bigger faster.
Mm,
I would have looked to do bigger deals, and I would have tried to do them faster, instead of being so cautious.
mm,
As an ex-banker, I'm cautious by nature, right? And two, something that I think I did right was I partnered early on, and I partnered to get scale too. Meaning, those larger deals are sometimes really hard to do by yourself, right? You don't have the pen to stroke on a note, or you don't have enough equity to be able to raise, things of that nature. And so there's other people that are out there, that are doing it. And man, leveraging their knowledge too was dramatic for me, because I was able to grow my knowledge base so much faster by partnering with those that have done it before me, and being able to grow that way, and learn from them too. So those
yeah.
would be the two things I would say that I probably, one, I would continue to do, right? And the other, I wish I would have gone a little faster, and larger right out the gate.
Excellent advice. And that's something that I think a lot of us struggle with, right? Is just going maybe a little bit too small early on, being a little bit too cautious. My background is as a CPA, so similar to you, it's like very cautious, very controlled. But as you kind of look back on it, it's like, well, look, I mean, what maybe I'd love to have you elaborate a little bit more. Like, what are some more of the reasons why bigger earlier? Is it just the bigger properties aren't as quite as much work? Like, I'd love to just have you unpack that a little bit more.
Well, I mean, all right. So when we were first looking at it, I was looking at stuff that going like, oh, maybe I'll do a 20 unit deal or a 30 unit deal, right? Or something of that nature. And then it was, well, you actually look at the numbers and the dynamics of it. You go, well, for me to be able to hire staff and to hire the people around me, I have to be at a scale that's large enough to be able to pay those people,
Yeah.
right? And if you go to that larger scale and you're able to buy pay for the talent that you need to be able to, you'll go so much better. You'll go so much faster, so much further, and you'll get better returns for your investors. I mean, it really is interesting when you're able to have. I really do think the best people and the best product will get you the best returns, right? And I start with people before I do product, because I do think if you are surrounding yourself with, those that are the best people, the most intelligent, those that are willing to work their tail off for the deal, you're typically going to do okay. You're going to do pretty well. And being able to get to that scale enables you to be able to hire those people and to bring that talent in. And so I think if you start small, you really are holding yourself back from growing into what you could be.
Yeah. Love that, man. That's such good advice. Such good advice. And I know that at your firm, I believe you focus exclusively on Texas, if not exclusively, mostly on Texas. You're based in Texas. You do a lot of deals there. So you'll look at Texas here the next several years. Are there any key trends that you're going to be monitoring in the Texas real estate market for the next, call it 3 to 5 years here? Like, what are you looking at in Texas right now that you think is really important?
Yeah, so there's a couple things. One, a lot of people probably don't realize that more jobs were created in Texas than anywhere else in the United States. And because of that, Texas had the most in migration than anywhere in the United States, meaning we have more jobs or opportunities and more people coming in to take them. And when you do that, you're going to have a need for housing, a need for storage. You have a need for all the things, a need for infrastructure, all the things that are going to feed those people, right? Both literally and figuratively, right? So you have infrastructure needs, you have more and more jobs that get created because you have all these people coming in. And so it's something that's a self-fulfilling prophecy. You keep having a lot of people keep moving in, there's going to be more and more demand for your product, almost whatever that product is. And so we're still very bullish on Texas as a state. And think it has a long runway to go, meaning we still see it having a lot more juice in the tank to go. And so we're still looking for opportunities out here to service the needs of not just the new people moving into the state, but those that are currently here. And I would tell you the demand is showing us that it's still pretty strong in the state.
That's awesome. Yeah, I'm bullish on Texas as well. It's I think the future there is very bright. It's a lot of what you're looking for in a real estate market with the population growth, job growth, business friendly, people just flocking there in droves. It's a very ripe environment for commercial real estate investing for sure. And when you look at locations for commercial real estate investing, some of the things we touched on are, I mean, it's not rocket science, but it's all stuff that's super important, right? The job growth, the wage growth, the population growth. When you choose either a market or a location for a commercial real estate project, are there any other just more under the radar, either factors that you might look for in a market specifically or qualities that you might look for in a piece of real estate specifically? Anything else that might be a little bit under the radar you might look
It's
for?
going to be more stuff to probably to stay away from.
Yeah, yeah, perfect.
I mean, honestly, but I would still say jobs is probably still going to be almost number one, right? Because people have to work, right? And if there are jobs aplenty, there's going to be demand for
Mhm.
that area, right? So if there is work there, you're going to get people, right? If you get people, they're going to want to live there, they're going to want to play there, they're going to want to worship there, they're going to want to do everything in that area. Um, the things I would say is more to avoid would be, crime, right? If you're in an area where it's a heavier crime area, we're probably going to try to steer away from that or just stay out of it because there's so many other things that come with it. Even in some of the areas where it's regentrifying, right? And, we're probably not going to be, the trailblazer into that. We're probably going to be, we'll hang back and make sure that it actually is going to be what it is. The other thing is schools too. So we're looking at school districts because if you're going to have jobs aplenty, but the schools are terrible, it's going to be hard for people to actually live there,
Yeah.
especially those that you're catering to families or things of that nature. And so, I would say that's probably those top two that I would say we would look to avoid was high crime and bad schools. But jobs are still probably going to be, from a qualitative perspective, one of the biggest things we're looking at because that's what drives so many positive things in an area.
Yeah, great points for sure, and ones that are very important for investors to pay attention to, no doubt about that. And I'd like to ask you a couple questions as well about more Sunset Capital specifically. So, look, it's a pretty competitive market out there. I mean, the competition right now is maybe a bit less than it was a couple years ago with interest rates going up and the market just really cooling off quite a bit. But when you look at the way that you guys try to differentiate yourselves in the marketplace, in a competitive market like Texas, a lot of competition for deals, a lot of competition for capital and equity as well, kind of in the syndicator space. So definitely a lot
Sure.
of competition. So you look at the way that you try to set yourself apart, or what your secret sauce might be at Sunset Capital. Like, what do you think that might be?
Yeah, on the equity side, um, it's pretty specific. I mean, I have a pretty unique background, probably a lot more different than a lot of other syndicators, and we're pretty technical too. So we cater to a lot of technical investors. So I would say our avatar, our typical investor is an engineer. Part of that is I'm in Houston, Texas. So we have a lot of engineers down here, but part of it is how we do our information, right? We're pretty technical with how we do it, and so it caters to that community and a lot of those engineers like that, right? Because it's language that they can speak.
Sure.
Um, on the deal side, I would say it's also a little unique too. One of the things that we've seen is you look for the deals, at least in 24, the bulk of the deals we looked at were either they were in some form of distress, whether it be for the asset, the loan, or the partnership, right? And being an ex-banker, I have kind of an open line to every lender in town.
Mm,
And so we kind of know even ahead of time in some cases, hey, if this deal is struggling, guys, let me let you know we're an option out there for you lender to be able to come to. And so if there is availability, we'd love to be able to take a look at it. And so we were looking at a deal today that it looks like it's going to go back to the lender, right?
mm.
And so we've already talked about talking to the lender directly because they would like nothing more than to get this thing off their books as fast as humanly possible. We're going to make them go through the process of everything so that we can get clean title to the property and clean deed. But we would probably be one of their options of choice to be able to go, hey, look, I can help you take a non-performing asset and turn it into a performing asset, right? And we know how to communicate with the lenders that way because that's a different vocabulary as well. Just like real estate has a different vocabulary, so does the lending world. And
100%.
being from that lending world, um, we kind of know exactly what they need to hear, how they need to hear it, and when they need to hear it, and then present them something that they needed to be presented in the way that they needed to present it to them. And so it comes across really well that way. And so, I think that gives us kind of a bit of a step up from a lot of our competitors because, we actually speak all the languages needed in that kind of a process with where we are in the market today.
Yeah, that's super fascinating and a great point too, and very pertinent too, given where we're at in the market cycle right now. And some of these deals are distressed for various different reasons, whether it's operations or partnerships or debt financing. Distress is something that's being talked about, and you see some of this stuff happening right now. So, for as a quick follow up to that, for people who maybe don't have the lending background that you do, how might investors try to potentially make inroads with bankers who might be in their market? If a group wanted to go out there and try to create a relationship with a bank to be able to see what their non-performing loans might be and to maybe try to position themselves for an opportunity like that, I'm sure there's probably some pretty significant relationship building that might need to happen. But what kind of advice might you have for somebody in a situation like that?
Yeah, I mean, if you really have no relationship with those people, I would actually try to partner. And what I mean by that is I'd probably go to a broker or two that maybe has already established those types of relationships
Mhm.
and go, hey, I'm looking for this. I can be the guy for anybody that has this type of distressed property and be very niche about it and what it is that you're looking for and what you can do and how you can handle it and have them try to put you in front of those lenders, right? to be able to do that. So leverage another person, because lenders are they're very relational oriented. And so it's a very different versus somebody who's got multiple decades of a relationship with them. It's a lot easier for me to pick up that phone and call them directly and go, hey, this is what I'm thinking. What do you guys have? Can we communicate about anything that you think might be coming up, right? And then can I be that potential outlet for you? And so it is a little bit different, but brokers are doing the same thing, right? I mean, they really are. And so I would leverage it with a broker. That's how I would do it if I was just trying to come in and figure that out. With me, it's a little different because I can say, look, we can do this and we don't have to use a broker, right? I can actually save you guys some additional money to where you're not having to lose, write off as much, right? And so that would be part of our value add of how we do it. That, and we do know, like I said, we know how to talk to them to make it make the most amount of sense.
Yeah,
So
that's great. That's great advice. I love the idea of pulling in a broker too. I've found, and maybe you found the same thing, anytime that I've brought to some of my broker connections some sort of creative way that I can potentially partner with them to go and get a deal, it's always something that's been very well received. They appreciate the creativity, they appreciate the thinking outside the box. And look, if you can bring them an idea or an opportunity for them to potentially go out and get a commission, again, it's usually something that's very well received by them.
they're motivated, right? And so that's why I would do it versus I would do it that route versus almost any others, just because you're going to have somebody who's motivated on your team to help you go get it done.
Yes, absolutely. And Sam, this has been great, man. As we start to wind it down here, I've got one last thing I want to bounce off you. Given your background in banking, and if memory serves, I think you might even sit on a bank board, if I'm not mistaken. So you kind
I
of
do
know
currently.
the banking space pretty well. And it's been kind of interesting. I had CBRE's global chief economist on the show a few weeks ago, and we were talking a bit about capital flows and commercial real estate valuations and that sort of thing. And one thing that he mentioned is that right now we're not seeing as much lending from banks in the world of commercial real estate. So I'd
Correct.
love to get your perspective here. How do you think that banks view lending in the commercial real estate world right now? Are they still pretty puckered up and pretty tight right now? Like, what might they want to see to kind of open up the floodgates a little bit more, and for us to be able to see some of those banking capital flows come back into the world of commercial real estate? What are your thoughts there?
Yeah, I can tell you, at least from my perspective, what I've seen is that it's liquidity.
Yeah.
So it's you could actually have a great deal. It checks all the boxes, and a bank won't do it. And the reason being is they either don't have enough in their bucket to be able to do it, or they don't have enough deposits on the other side to justify going, this is a true relationship and let's move forward. And so I would tell you that's really where they're pushing more to, is that they need the liquidity coming in, i.e. the deposits,
Hmm.
to be able to make those kinds of loans, to continue to generate those types of deals. And so it's not necessarily like, hey, we're in trouble. It's, hey, there's been a pause here. Let's hold off and just figure out where we're at, and let's look at the portfolio overall. So in banks, right, community banks in particular, but all banks, they have what's called ALCO, ALCO, and that's your asset liability committee. It's actually
Hmm.
run by the board of directors, and that's the balance sheet of the bank, right? And all they're doing when this ALCO committee meets is they're going, hey, we have these types of deals and these types of deals. We have this much cash effectively that we can lend out, guys. And we know we'll have deposits coming in and going out. But if this is the bucket that we have to lend, what types of deals do we want to do given that this is our balance sheet, right? So think about it from the perspective of they already know where they're heavy or where they're light, right? And the mandate will be, okay, guys, we can go do these types of deals. Let's just say it's A-class apartments only because we don't have enough in our bucket for that. But it's going to be done at this pricing, and we want to know we have these kinds of deposits to get those types of deals done. And preference would go to those that are already customers of the bank,
Hmm.
meaning those that we already have established relationships with, right? The people that we know, right? Because we're looking to mitigate the risk, right? And keep the liquidity as high as we can when we're pushing those deals out. And so the thing is, this is hit kind of all over, and there's so many banks that are going, all right, well, we're shrinking, right? What we're going to be willing to do, meaning our loan to values will go down, or what we're willing to lend and how we're willing to lend it has changed, right? I always joke because a banker has 1,000 ways to say no that all start with yes. Okay. Meaning, yes, I'll do that loan, right? I mean, it may be at a 20% loan to value and you're going to have to
Right.
pledge, CDs to cover the rest kind of thing. But yes, I'll do that deal, right? Um, and so it's a liquidity thing. If you look at the bank's balance sheets, and it's fairly widespread, right? And so, whether they're state banks or national banks, right? Their regulator bodies are looking at them and going, guys, make sure that you are secure, make sure your loan loss reserves look good, make sure you have the liquidity to weather whatever potential storm this looks like this could be. And if you have overexposure to, let's say, the office market, right? We may think you might have to be doing some additional write downs of assets, and you'll start seeing that in the quarters, especially with the publicly traded companies. You already have seen it where they're starting to write down a lot of these assets that they have on the books, even though they still could be performing or not performing, but they're writing down the values already on those deals, and so they're being cautious from a commercial standpoint of where they're lending money.
That's super duper helpful. And one last quick follow up on that. What do you think it might take for the banks to free it up a little bit more and to start lending a bit more in the commercial real estate space? Is it, valuations going up a bit and interest rates kind of coming down and more deals being able to get done? So some of these loans that are on their books get sold and now there's more capital to redeploy. Like, what do you think it looks like for banks to just want to lend a bit more in the
Yeah,
space?
and so that would be a great help, right? Because if they're able to start turning things, because banks in general are shorter term lenders, right? I mean, they're doing loans, let's say, for 5 years or less, right? They're short term by nature. That's just how they are. Um, and so if you start having turn of the portfolio, yeah, they're very eager to put that capital back to work. Um, but like I said, it's liquidity, right? So, a lot of deposits left the banking sector, especially during the COVID times and things of that nature. And so a lot of that money just hasn't found its way back into banks. If that finds its way back, it's just like capital, right? It's just they get it in, they immediately are going to look to start putting it out so that they can earn on those assets. Um, and as treasury rates continue to drop, right, loans look a lot more attractive. Almost any kind of loan looks a lot more attractive from a risk-based perspective than buying treasuries or buying some other alternative assets that they're going to hold. So,
Makes sense. Sam, this has been a great conversation today, man. I really appreciate you stopping by and speaking with me and sharing your wisdom with our audience. And if people want to follow you and what you've got going on at Sunset Capital, what's the best way to do that?
man, easiest way is to just get to our website at sunset-capital.com. Come on in, check us out, and we love communicating with new people and figuring out who's doing what deals and introducing ourselves to new investors. So we always got stuff working. So it's great. It's a great way to see what we got going on.
That's awesome, Sam. Again, thank you so much for your time today, man. Really, really appreciate it.
Tyler, loved it, bud. Good to see you.